Hey everyone, and welcome to your options education station. Today, we're diving into a strategy called covered calls. Ever feel stuck with a stock? It just sits there, not going anywhere? Covered calls might be the answer. They're a way to squeeze some income out of those shares you already own, while also adding a layer of protection if the market takes a tumble. Think of it like this. Covered calls are like selling insurance on your own stock. You collect a premium upfront, but you also agree to potentially sell your shares at a certain price, by a certain time. Sounds interesting, right? But there's a catch, and of course, there's always a catch. We'll break down the good, the bad, and the juicy details of covered calls in the next few minutes. So, stick around and see if this strategy fits your investing style. What happens if the stock price falls significantly after a covered call is initiated? When you initiate a covered call and the stock price falls significantly afterwards, it creates a situation with both positive and negative aspects. Let's break down what happens. The downside. Loss on the stock. The main drawback is that you will experience a loss on the underlying stock price. As the stock goes down, so does the value of your shares you hold. Potential early assignment. If the stock price falls sharply and breaches the strike price of your sold call option, the buyer of the call option might exercise their right to buy the shares from you at the strike price. This is called early assignment. While you will receive the strike price, it will likely be lower than the price you originally paid for the stock, locking in a loss on the stock itself. The upside, limited profits, but some protection. Premium income. This is the benefit of a covered call strategy. Regardless of the stock price movement, you get to keep the premium you received when you sold the call option. This premium acts as a buffer against the stock price decline, reducing the overall loss compared to simply owning the stock outright. Downside protection. To a point, as long as the stock price doesn't fall below the strike price minus the premium received, you won't suffer any additional losses on the stock. The premium acts as a buffer zone, protecting some of your investment. Covered calls are a strategy for generating income and reducing downside risk, but they also limit potential upside gains. A significant drop in stock price can still lead to losses, but the premium income helps soften the blow. Here are some additional points to consider. Volatility. Covered calls work best in situations with moderate volatility. If the stock price swings wildly, your strategies might need adjustments. Time decay. The value of the call option you sold erodes over time, time decay. This can be beneficial if the stock price stays flat or falls slightly, but it reduces your overall return if the stock price increases significantly. What happens if the stock price increases dramatically after a covered call is initiated? If the stock price increases dramatically after initiating a covered call, you'll encounter a situation with a bittersweet outcome. Here's a breakdown of what happens. The downside, missed opportunity. Capped gains. The biggest drawback is missing out on the full potential profit from the stock's significant price increase. Since you sold the call option with a fixed strike price, you'll be forced to sell your shares at that price if the option gets exercised. Potential early assignment. If the stock price shoots up and breaches the strike price by a significant margin, the call option buyer might be incentivized to exercise early to lock in their profit. This forces you to sell your shares at the strike price, even though the market price is much higher. The upside, premium income and some profit. Premium income. Regardless of the stock price movement, you get to keep the premium you received when you sold the call option. This premium becomes a guaranteed profit, even though it's smaller than the potential gain you could have made if you held the stock without the covered call. Profit on the sold shares. Up to a point, if the stock price increases but stays below the strike price, you won't be assigned early and get to keep your shares. You'll still benefit from some profit on the underlying stock, although capped by the strike price. Covered calls limit your potential gains in exchange for guaranteed income, the premium, and some downside protection. A dramatic stock price increase highlights this trade-off. While you miss out on significant profits, you still earn a return and potentially avoid larger losses if the price had fallen instead. Here are some additional points to consider. Choosing the right strike price. Selecting a higher strike price allows for more upside potential if the stock price increases, but it also reduces the premium you receive and increases the chance of early assignment. Rolling the call option. In some cases, you might consider a strategy called rolling the call option. This involves buying back the original call you sold and selling a new call option with a higher strike price to capture some of the additional gains. However, this involves additional transaction costs and carries its own set of risks. Can covered calls be used to hedge existing stock holdings? Absolutely, covered calls can be a valuable tool for hedging existing stock holdings. Here's a detailed explanation of how they work in this context. Hedging with covered calls. Concept: a hedge aims to protect your portfolio from potential losses. Covered calls involve selling call options on stocks you already own, long position. This creates a synthetic ceiling on your potential gains while offering some downside protection and generating income. Downside protection. Limited losses. If the stock price falls after initiating the covered call, the premium you receive from selling the call option acts as a buffer. Even though the stock loses value, the premium helps offset some of that loss. For instance, if the stock price dips but stays above the strike price minus the premium received, the overall loss is smaller compared to simply owning the stock without the covered call. Reduced upside potential. Capped gains. The key trade-off is that covered calls limit your potential profit if the stock price increases significantly. Since you've sold call options with a fixed strike price, you're obligated to sell your shares at that price if the option gets exercised. This caps your gains at the strike price, plus the premium received. Premium income. Guaranteed income. Regardless of the stock price movement, up or down, you get to keep the premium you receive when you sell the call option. This premium becomes a guaranteed source of income, even if the stock itself doesn't perform well. Overall impact. Covered calls transform your existing stock holding into a more income-oriented and potentially less volatile position. You give up some potential upside for some downside protection and guaranteed income. Here are some factors to consider when using covered calls for hedging. Volatility. Covered calls work best with stocks with moderate volatility. If the stock price swings wildly, your hedge might not be as effective, and adjustments might be necessary. Strike price selection. A higher strike price offers more potential upside but reduces the premium and increases the chance of early assignment. A lower strike price offers stronger downside protection but reduces your potential gains and increases the premium. Choosing the right strike price depends on your risk tolerance and investment goals. Time decay. The value of the call option you sold decreases over time, time decay. This can be beneficial if you want to hold the stock for a while and the price stays flat or dips slightly. However, it reduces your overall return if the stock price increases significantly before the option expires. Are there different types of covered calls with varying risk profiles? Yes, there are indeed different types of covered calls with varying risk profiles. By adjusting certain aspects of the covered call strategy, you can tailor it to your specific risk tolerance and investment goals. Here's a breakdown of some common variations. Standard covered call. This is the most basic type of covered call, where you sell a call option with a strike price slightly above the current stock price and an expiration date that aligns with your investment timeframe. It offers a balance between income generation, moderate downside protection, and some potential upside if the stock price increases modestly. Variations for different risk profiles. Conservative covered call. Lower strike price. Choose a strike price significantly below the current stock price. This increases your downside protection, potentially offsetting losses from a falling stock price, but reduces the premium income and significantly caps your potential gains. This is ideal if you're highly risk-averse and prioritize protecting your existing stock holdings. Longer expiration date. Selling calls with a further out expiration date allows more time for the stock price to potentially increase and reach the strike price. However, this also means a lower premium received due to increased time decay. This approach is suitable if you believe the stock has a good chance of appreciating in value over a longer time frame, but want some downside protection in the meantime. Aggressive covered call. Higher strike price. Select a strike price well above the current stock price. This maximizes your premium income but offers minimal downside protection and significantly limits your potential gains. This strategy is appropriate for situations where you're less concerned about stock price fluctuations and prioritize generating income, even if it means sacrificing some potential upside. Shorter expiration date. Selling calls with a shorter expiration date leads to a higher premium due to less time decay. However, it also reduces the chance of the stock price reaching the strike price for assignment, potentially leading to missed gains if the price surges. This approach is suited for scenarios where you anticipate the stock price remaining relatively flat or slightly increasing in the short term and want to maximize your income potential. Additional variations. Cash secured puts. This is a similar strategy to covered calls, but instead of selling call options, you sell put options. You then hold cash equal to the strike price to potentially be obligated to buy the stock at a certain price if the option is exercised. This can be used to generate income while potentially acquiring a stock at a discount. Bullish covered calls. This involves selling a covered call with a strike price slightly above the current stock price, but also buying a put option with a lower strike price. This provides some additional downside protection while still allowing for some potential upside if the stock price increases. However, it requires additional costs associated with buying the put option. How do covered calls fit into a diversified investment portfolio? Covered calls can be a valuable tool within a diversified investment portfolio, offering several benefits. Income generation. Covered calls allow you to generate income through the premiums received from selling call options on stocks you already own. This can be a great way to supplement returns, especially in a low interest rate environment. Downside protection. By setting a strike price for the call option, you create a buffer against potential stock price declines. The premium income you receive helps offset some of the losses if the stock price falls. Reduced portfolio volatility. Covered calls can add a layer of stability to your portfolio by reducing its overall volatility. Since you're capping your potential gains, you're also limiting potential losses, leading to a smoother investment experience. Improved portfolio diversification. Covered calls are not directly correlated to the overall stock market. This means they can help diversify your portfolio and potentially reduce its overall risk. Even if the stock market experiences a downturn, the income generated from covered calls can help mitigate some of those losses. Integration with different investment strategies. Covered calls can be used alongside various investment strategies. For example, you can use them on stocks you plan to hold for a long time to generate income while still benefiting from some potential upside if the stock price increases modestly. Alternatively, you can use them on stocks you're unsure about but want to hedge against potential losses. However, it's important to consider the limitations of covered calls when incorporating them into your portfolio. Capped gains. Covered calls limit your potential upside gains if the stock price increases significantly. You're obligated to sell your shares at the strike price if the option is exercised, even if the market price is much higher. Time decay. the value of the call option you sell erodes over time decay. This can be beneficial if the stock price stays flat or falls slightly, but it reduces your overall return if the stock price increases significantly before the option expires. Stock selection. Covered calls work best with stocks with moderate volatility. If the stock price swings wildly, your strategies might need adjustments, and the effectiveness of the hedge might be reduced. Here's how covered calls can be used in different portfolio contexts. Income portfolio. If your primary goal is generating income, you can focus on selling covered calls with stocks with high dividend yields and a history of relatively stable prices. This allows you to collect income from both dividends and option premiums. Growth portfolio. Even within a growth portfolio focused on capital appreciation, covered calls can be used on a portion of your holdings to generate income and hedge against potential downturns. Retirement portfolio. Covered calls can be a valuable tool for retirees seeking income and some downside protection for their existing stock holdings. Alright, so that's the covered call rundown. Remember, covered calls are a strategy for income generation and downside protection, but they do cap your upside potential. Before you jump in, consider your risk tolerance, investment goals, and the volatility of the stock you're thinking about using. Covered calls can be a great addition to a diversified portfolio, but they're not a one-size-fits-all solution. If you're interested in learning more about covered calls or options trading in general, leave a comment below and let me know what you'd like to see next. Don't forget to like this video and subscribe to the channel for more in-depth options education. Thanks for watching.